So, it's official. The Fed has sent the clearest signal so far, indicating that interest rate cuts are coming in 2024. After Powell's speech, everything from global stocks to corporate bonds rose sharply. And in today's video, I'm going to talk about how Singapore REITs can benefit from lower interest rates next year. Of course, not all REITs or trusts are created equal, and you need to watch until the end of the video as we try to pick up some winners for you. I think by now you would have known how REITs work. They borrow from banks to invest in properties and pay out 90% of the income as dividends. In good times where interest rates are low, REITs are like no-brainer stable dividend stocks and nothing can seem to go wrong. However, when interest rates are high, like where we are right now, REITs are affected by higher borrowing costs and their portfolio valuations will also take a big hit, like what happened to the US office REITs, Manulife, Prime US REITs, and more. And now, with interest rates expected to come down in 2024, it will be definitely a boom for REITs. However, like what I shared, not all REITs will benefit from it. Okay, so some of them will benefit more from the lower interest rates than others. At the very least, you should be aiming to sift out the bad apples with a few screening criteria and then do further analysis into each of the REIT itself. I'm gonna try and pick some of the best REITs in 2024 using a mix of some simple factors here, nothing complicated. So first one is distribution yield must be more than 5%. Gearing must be lower than 45%, price to book lesser than 1 times, and property yield more than 5%. Before we go on to the whole list of REITs and trusts, let me explain why I chose this particular screening criteria. So first of all, you will see that these are all quantitative numbers. So there won't be any reputable sponsor criteria since it's pretty subjective and we cannot really screen for this kind of qualitative filter, right? So secondly, many blog posts out there, like the one from Sidley, okay, you can see that there are really many criteria to look at. But as always, I prefer to keep things simple and broad enough so that I can analyze it more in depth myself. Next, let me quickly explain why I chose this criteria. First one is distribution yield more than 5%. Okay, so I need it to make the investment more attractive for income-focused investors. If it's below 5%, right, why not you just go for fixed deposits or government bonds with a guaranteed 3+% returns? And the second one is gearing. Gearing has to be below 45% because portfolio valuation can still decline and you definitely want a margin of safety right now to tie through the high interest rates environment. Third is the price to book ratio below 1 times. This essentially means that we are buying the assets at a discount. So assuming they can continue to rebound to even just 0.8 times or to 1 times price to book, okay, to normalize to that level, this already represents some nice capital gains on top of the enticing distribution yield. Last but not least, the property yield is derived from net income divided by total property value. This is important because it measures how well the REIT is being run, and we chose a minimum 5% so that it's in line with our distribution yield too. So with that, I want to thank Fifth Person for their website, okay, to display all the relevant data in a very nice table format here. To help you to get started, I already done some sorting and highlighting based on my own criteria, so the 4 criteria, and shortlisted some of the so-called best REITs. You can see from here that all the list of REITs and trusts with all the 4 highlighted fields are bold and blue in color. Before I move on to the next point, I have something exciting to share with you guys. I'm proud to become a trainer for an IBF accredited and Skills Future approved investment workshop called the Intelligent Investing in the Era of Disruption. Some of the things taught in the workshop include how to use AI to analyze stocks, how to pick the right companies using real life case studies, and also how to build a winning portfolio for the long run. If you're interested to find out more, you can click on the link down below. It will direct you to a Google form where you can fill up the details and we will contact you shortly. With that, let us head back to the video again. So among all the REITs that pass the screening, of course there are those that I've done more research on, and here are three of them that I like personally. A quick disclaimer here, any REIT or trust picks shared here are for informational purposes only. So please do your own due diligence. Okay, so the first REIT that I like is CapitaLand China Trust. Okay, this is a China-focused shopping mall REIT with a portfolio of over 11 malls, 5 business parks, and 4 logistics parks, all in China. So some of the things I like about this trust is that there's a renewed focus on the new economy assets after they expanded their mandate to include business parks and logistic parks. So they can now capture the up and coming tech innovation and domestic consumption trends. Next is of course the CapitaLand sponsor branding. Growth is not an issue when they have a robust pipeline from the CapitaLand sponsor, right? On top of the ongoing AEI, asset enhancements initiatives, as well as development projects to unlock the value inside. Other than looking at the fluctuating, distribution per unit due to COVID as well as forex, because of renminbi, right? We zoom in on the net property income, which the trust can control, and you can see that it's up a healthy 10% CAGR since 2010, coupled with a property yield above 5% too. Moving on, the second one that I like is Keppel Pacific US REIT. Okay, this is an US office REIT with freehold office buildings and business campuses located across key growth US markets. Some of the merits are, as of third quarter 2023, it has a high occupancy rate of above 90%, not as jialat as what people think the vacancy rate is, and a healthy 39% gearing. So portfolio valuation would need to drop 23% before they face the same problem like Manulife US REIT. Okay, so this represents a very good buffer given that interest rates are also going to come down soon. The best part I like about this REIT is that people are leaving the popular gateway cities such as Los Angeles, New York, Washington DC, and moving to key growth markets which the REIT has, like Houston, Dallas, or the Sun Belt region in general. Okay, so based on this picture, the research says that all the ages are drawn to the area for many various reasons like business-friendly environment, lower cost of living, and better weather. So these will definitely bode well for Keppel REIT going forward. My third personal favorite is, drumroll, Sabana Industrial REIT. Okay, the portfolio comprises of 18 quality industrial buildings located entirely in Singapore. Three key things I like about it is that firstly, I was working as share investor previously. So the office is at the newly revamped new tech park. So I can literally see the transformation happening there. A very old industrial building to, they transform it into a very nice and glamorous, like a modern building. Okay, with a good mix of tenants. Next, with many REITs facing a drop in rental rates, Sabana REIT is the one of the few, right, that can continue to increase rental consecutively since 2021. And the last part that I like is conservative and sustainable capital structure. They have a very low gearing of 32% and interest coverage of 3.5 times. So you can see that you can easily fund the capital expenditure and growth plans with such a big debt headroom. Before you go, hey James, why you pick these three REITs? All got issues one. Yes, I purposely picked these three stocks because they are mired in some kind of controversial issues. And that is where I believe the value lies. So let's talk about the three of them. First one, CapitaLand China Trust. It's based in China, and a lot of people think that the economy is weak right now. But I believe that China is so big, okay, the market size is so big. With a strong sponsor like CapitaLand, it can easily grow on top of the newly revised mandate. Second one, core REIT. It is in the depressed US sector, US office sector, okay? But the worst seems to be over and interest rates are coming down already. So the upside is a lot from right now. Lastly, Sabana REIT is embroiled in a saga that turns out pretty well under the leadership of Quartz Fund. Given that Quartz has succeeded in the quest to boot the ESR Group external manager, it is possible that they can continue to push for more bullish measures from now on. So that's a wrap for today's video. What other REITs are you interested in and want me to cover? Let me know in the comments down below, and also help me to smash the like button. Make sure to subscribe to my channel and hit the notification bell, because I will be doing a Disney stock video in the next one after I went to Hong Kong Disneyland in the past week. Okay, so next up, if you have the time, you can also watch this video over here where I compare the 3 local Singapore banks and share my favorite pick. With that, thanks for watching and I will see you next time. Bye.